Hello, everyone. Thank you once again for joining me. So, today we will be talking about buying your first home in Canada. My name again is Peter Ezekwe. I'm a mortgage associate with Centrum Financial Services. Okay. So, what are the requirements that you would need when buying a home? There are a major of them. We've got the minimum 5%, and these ones require a proof of funds. So, by that, it means you must have them for at least 90 days available. Um, You have to gather or get your closing costs balances. So this will include your lawyer fees, inspection costs, property tax balances, etc. You should have a good credit score. Banks like to see people with good credit score. With CMHC, you're looking at a minimum of 600. Different financial institutions do have their own definition of good credit score. Get a pre-approval from with a mortgage broker of a financial institution of your choice, and then find yourself a real. So to that, there are a few types of down payment one must know. There is down payment from savings or investment. This type of down payment would require proof of funds. So like your statement for at least the last 90 days prior to application. Gifted down payment. This type of down payment does not require any proof of funds. Usually they come from family members or relatives. However, they must sign a gift certificate indicating they do not have any interest of that fund being repayable. Down payment from RSP. So if you don't have a down payment and you're looking to take advantage of the RSP your employer is providing to you, you should be able to do that with something called a home buyer's plan. Here are some few things you should know, some few conditions you should know. A maximum of $35,000 is what you can use for a home buyer's plan from your RSP. It must have been available for at least 90 days. You must pay it back within 15 years from the day you borrowed it, and it's only applicable to first-time home buyers. Okay, for more conditions regarding the home buyer plan incentive, I strongly recommend you look at the CMHC page. Okay, then we're looking at the down payment for first-time buyer incentive. I'm going to speak a little bit on this first-time home buyer incentive because that's quite a broad topic. So here we're looking at the down payment condition for first-time home buyer incentive, like I mentioned. So some of the conditions include your total annual qualifying household income. So household will include if you are married, you and your person, you and your couple, you and your partner, right? That's what the household will mean. So your total qualifying income cannot exceed 120,000 if you live in any provinces other than Victoria and British Columbia, Vancouver, British Columbia, and Toronto in Ontario. Those ones are required to have a minimum of $150,000, but they're the only exception. Every other residents in Canada cannot exceed 120,000 household income to qualify for the first-time home buyers plan. The other condition is your total borrowing is no more than 4 times your household income. For instance, if you're going to use a first-time home buyer plan, you're making 100,000 or 120,000 as a family, then you cannot exceed 480,000. That's basically what it's saying. You can't exceed 480,000 for you to qualify for that. Okay, you or your partner are a first-time home buyer, so it's only applicable if you and your partner are first-time home buyers. However, if you don't have a partner, that's fine. If it's your first time buying, you can definitely use that. Okay, but it's just something you should know. If one of you is a first-time home buyer, apparently you will not be able to use this. You would have to use the tax credits, first-time home buyer tax credit. Okay, you're a Canadian citizen, PR, or resident as a worker in Canada. You meet the minimum income requirement, which is down payment requirement. So usually that one, they want to make sure you have at least the 5% down payment before you can actually get this. So these are some of the factors you should put in mind when dealing with the first-time home buyers. This is the conditions. These are the main conditions to focus. Let's talk about the benefits of that. As you can see, it provides you the additional down payment. It helps lower your mortgage payments, and it gives you up to 5% or 10% if it's a newly built home. Repayment is only when the house is sold. Okay. Now you should also know that the first-time home buyers also mean that the government has a share or equity on your home. So if they give you 5%, that means they have a 5% equity in your home. If they give you 10%, that means they have 10% equity on your home. So whenever you sell the house, if you make profit, you would pay them their 5% plus plus and minus, there's a plus and minus to that range. So up to a certain amount, it's not usually exceeding a certain amount, but up to a certain amount, there's a plus and minus to that, how much you pay them back. But it's not something to panic. I'm just letting you know that it's an equity type of thing. It benefits you in the meantime while you're buying a house, but eventually when you sell it, you have to pay back the government what they give you. That's what it all means. Now, 5Cs. Let's talk about the 5Cs. I don't know if many people know, but of the 5Cs, there are three most important ones that banks really, really care about. So here we have I'm just going to go straight to the three most important one. So the credit, the collateral, the capacity. The reasons why they always focus on these three things is the credit usually tells the bank that you show a willingness to pay. Okay. And then that would be something they would find in your credit report. Okay. The collateral shows that the security of the property. So basically, if I'm buying a house, and I'm the bank, I want to be sure that if anything happens, the value of the house is worthy of the security. So if you can't go buy a $200,000 house for $500,000, it does not say anything good about security. So it has to be secured. That's why collateral is very, very important. Capacity also shows your ability to pay for that debt. So those are the three major important C's that the banks look at whenever they are reviewing the 5 C's of credit of an applicant: the credit part, the collateral part, and the capacity part. Now let's talk about the debt service ratio. So a debt service ratio measures the ratios of debt to income in terms of percent. So basically, it just goes to say that they're putting in this way that they don't want applicants to go over 44% of their income in debts. They don't want to see applicants spend more than 44% of their income in debt. So that's what the debt service ratio just basically calculates. It is very, very important to actually note this because this could make or break whether or not you get approval for a mortgage. The debt service ratio is like one of the most important factors to take into mind. So when you're buying a house, you want to take into consideration your debt service ratio. GDS usually focuses on the PITH. We call that the principal and interest, which is the mortgage payment in question, the taxes, and the property hit. So usually this one's is just a minor, and the maximum industry allowable standard is 39%. The TDS is the major one because the TDS encompasses the GDS as well as your all other debts. So you're looking at your line of credits, your overdrafts, your loans that could be car loan, student loan, um, your credit cards. It also includes child support and alimony support. So basically, any type of money that you pay monthly. However, what it doesn't include is things like your insurance payment for your home, your insurance for your car, or your insurance premiums, and maybe your savings and all that stuff. No, that's not your TDS. TDS just basically calculates your debts. So what is actually a debt? So we can see how child support and alimony support can be seen as debt, right? So things that have like an authorized monthly kind of payment that you're paying for something that you borrowed. So not when you are like doing for insurance and all that stuff. So just have that in the mind, back of your mind. And the maximum allowable for that one is 44%. However, there could be some cases of exception where the file is really, really strong, the character is really, really strong, but most financial institutions tend to say no whenever your TDS is above 44%. Now, there are two main functions of the TDS, okay? It pre-qualifies the borrower by determining the maximum mortgage amount. So basically what this does is it helps you to pre-qualify if you to help you know how much is your maximum mortgage payments that you can afford. Okay. It also verifies if your mortgage payment falls within the TDS ratio. So basically, these are the two reasons why banks usually focuses more on the TDS because, like I said, it's a combination of the GDS and all your debts, right? So this is the main thing that could either make or break your mortgages. So if you're looking to lower your TDS, the best bet is if you have credit card debts, line of credit debts that needs to be paid off, let the bank know that you're willing to pay them off prior to closing the mortgage deal. Okay. Now, for this particular slide is for people who are self-employed. So for self-employed applicants who are looking to buy a home, don't panic. You can definitely qualify. Just a few things to note here. Your down payment minimum is usually 5%. However, if it's a house greater than 500,000, this is the breakdown. So the first 500,000 will be 5%, and anything additional to that is 10%. You can see the mathematical calculation of that. Your maximum mortgage amount by CMHC is usually $1 million. Recommended minimum of 24 months of operating the business. So you must have been in the business for at least 24 months, or you have been in the same line of work. Sometimes there are some strong cases where conditions can be looked at to make the case work, but this is just some of the things you should have in the back of your mind. Okay, must be a permanent resident, worker in Canada, or a citizen. Income eligibility for self-employed. So for income eligibility for self-employed, stated income is not something that is acceptable by most financial institutions. They will still need some kind of proof. Okay, up-to-date personal income tax. Notice of assessment that must be accompanied by T1 General. Usually that just shows you, like it just helps determine the source of income. Okay. Like I said, it just helps determine the source of income, where that's coming from. The proof of income is another one. So this one is usually issued by CRA. Statement of business. It should. This is where you bring your T2125. But I should also note that it doesn't mean you have to bring all this, okay, when you're doing an application. So sometimes just two of them is okay. So let's say you bring your notice of assessment plus your personal income tax. Boo, good, because your notice of personal income tax shows that you filed your taxes. Basically, it tells you if you're or tells the lender if you're owing or if you're giving back some money. And then the T1 General just basically shows out all your income source, like how your income is broken down for that year, right? However, you should also note that because some people like to claim lower income when they are buying homes and they don't want to claim the larger income, and when it comes to time of buying homes, they do state that they make more. It is important to know that CMHC would only allow you gross up your income by an increase of 15%. So let's say you're claiming 100,000, so 15% to that, you're looking at about 115,000. That's how much maximum you can go up to. So this is just some factors you should have in the back of your mind as well. Okay, then this now brings me to my final slide, I think, or one of my final slides. So we're going to talk about things you should do when you're buying a home. This is very, very important. You should like take this very seriously. I think number one is property inspector. If you're buying a home that you know has been lived in before, it's not brand new, newly built, I strongly recommend you get yourself an inspector. This is like, to me, the most important, if not the important part. Get an inspector, because the results they tell you will either make the deal or break the deal. Sometimes you may not know the furnace might be bad, or the water tank might be too old, requiring replacement. The shingles might be old and stuff like that. Nobody will tell you that. The windows might not be retaining heat, So usually recommend getting an inspector to get that inspected. Get your home insurance, get a lawyer to help you close the deal, get a realtor to help you find your desired home, as mentioned, get a mortgage broker, as mentioned. Set up your property tax account. Okay, a lot of people don't know that, but set up your property tax account. So if you don't want the bank helping you make your property tax payment, set up a property tax account for yourself. If you want to do every monthly contribution to make it cheaper for you, fine. If you usually get a bonus and you sometimes decide to use that bonus to pay it off, then great. That's a fantastic way to go about it. But these are some things. Okay? And finally, if you're buying a newly built single family home, nobody ever tells you this, but the truth be told, please have your after purchase funds to cover for your landscaping, fences, decks, because most times the builders will not do any of these things for you. And I'm telling you, we're talking about minimum of $10,000 if you're lucky to cover for all this. You're looking at least 12 to say $20,000 to cover for this. So this is an expense that nobody ever tells you about, but you should have it in the back of your mind. Okay, in a brand new home, have in the back of your mind that the deck is your responsibility, the fences are your responsibility, and the landscaping and tree, if you want to plant a tree, are all going to be your responsibility. That brings me to the end of the slide, to my presentation, and thank you so much for watching. Once again, like, comment, share, and please subscribe. Thank you once again. Have a nice day.